Alright, let's talk about what just happened with SCHD, because this is one of those moments that long-term investors, income investors, and even cautious traders cannot afford to ignore. SCHD has always been seen as the boring but reliable dividend ETF, the one people park money in for steady income, stability, and peace of mind. But what just happened is not boring at all. In fact, this move could change how SCHD performs going forward, how investors should think about dividend ETFs, and what you should be preparing for next. For years, SCHD built its reputation on a very clear formula. It focused on high-quality U.S. companies with strong cash flows, consistent dividend payments, and a history of financial discipline. Investors loved it because it wasn't flashy. It didn't chase hype stocks. It didn't depend on speculative growth. It paid you to wait. Month after month, year after year, SCHD became a core holding for income-focused portfolios. But here's the thing. Markets change, interest rates change, corporate balance sheets change, and most importantly, investor expectations change. SCHD just made a move that signals it is adapting to a new environment and that adaptation has serious implications. Recently, SCHD adjusted its underlying structure in a way that caught many investors off guard. This wasn't just a small rebalance that happens quietly in the background. This was a noticeable shift that affects sector exposure, dividend reliability, and potential future returns. If you're holding SCHD, thinking about buying SCHD, or relying on it for income, you need to understand why this happened and what it means. First, let's talk about why SCHD would even make a move like this in the first place. Dividend investing has been under pressure. Rising interest rates made bonds more attractive. High-yield savings accounts suddenly started paying real money again. That pulled some investors away from dividend ETFs. At the same time, certain sectors that traditionally paid strong dividends, like financials and consumer staples, started facing margin pressure, slower growth, and higher costs. SCHD could not just sit still and hope everything would go back to normal. Sitting still in a changing market is actually one of the biggest risks there is. So the fund managers made a decision to adjust how SCHD positions itself for the future, even if that meant surprising investors in the short term. One of the biggest changes came from how SCHD rebalanced its holdings. Some familiar names were reduced or removed, while other companies gained more weight. This matters because SCHD is rules-based, and when those rules lead to changes, it reflects deeper shifts in dividend strength and financial health across the market. Companies that once looked like rock-solid dividend payers are now being scrutinized more closely. Free cash flow matters more than ever. Debt levels matter more than ever. And SCHD's move shows that the bar has been raised. This is not a bad thing, but it does mean the ETF you thought you knew is evolving. Now here's where things get really interesting. This move could change the risk profile of SCHD. Many people assume dividend ETFs are automatically safe. But safety is relative. SCHD is now leaning more heavily into companies that can sustain dividends even in tougher economic conditions. That could mean slightly lower yield in the short term, but potentially higher reliability over the long term. If you were only looking at SCHD for the headline yield, this might feel disappointing. But if you're looking for income you can actually depend on 5, 10, or 20 years from now, this shift could be very positive. Another important angle is dividend growth. SCHD has never just been about high yield. It has also been about growing dividends over time. The recent changes suggest that the fund is prioritizing companies with the ability to keep increasing payouts, even if inflation stays sticky or economic growth slows. Think about what that means. In an environment where prices are still high and purchasing power is under pressure, dividend growth can matter just as much as yield. SCHD's move signals that it wants to protect investors not just today, but in the future as well. Let's also talk about sentiment, because sentiment around SCHD has been mixed lately. Some investors were frustrated by slower price appreciation compared to growth ETFs. Others were concerned about dividend fluctuations. This move could help reset expectations. SCHD is not trying to compete with high-flying tech funds. It's reinforcing its identity as a disciplined, quality-focused income ETF, even if that means making uncomfortable adjustments. That's often when the best long-term opportunities are created. When an asset disappoints people who had unrealistic expectations, but quietly improves its fundamentals. Now, the big question everyone is asking is, what should you do right now? Should you buy more SCHD, hold what you have, or move on to something else? The answer depends on why you own SCHD in the first place. If your goal is fast capital gains, SCHD was never designed for that. This move doesn't change that reality. But if your goal is steady income, lower volatility compared to the broader market, and exposure to financially strong companies, then this change could actually strengthen your thesis. However, you also need to be realistic. SCHD is not immune to market downturns. If we see a broader economic slowdown, dividend ETFs can still fall in price. The difference is how they recover and whether the income continues to flow. What SCHD just did suggests it is trying to improve its ability to weather storms. That's not exciting in a headline-grabbing way, but it's extremely important for long-term investors. Another thing to watch closely is how SCHD behaves compared to other dividend ETFs going forward. Some funds chase yield aggressively, taking on more risk. SCHD's move suggests it's choosing discipline over temptation. Over time, that difference can be huge. It's also worth mentioning that this move could attract a different type of investor. Investors who value quality, consistency, and rules-based discipline may start to see SCHD as more attractive again, especially if market volatility increases. That could support demand for the ETF and help stabilize price action. Now let's talk about timing, because a lot of people are asking if this is the moment to get ready. Get ready doesn't mean panic buying or selling. It means adjusting your expectations and your strategy. If you already own SCHD, this is a moment to review your portfolio. Make sure SCHD still fits your goals. Check how much income you're relying on from it and whether you're comfortable with its evolving structure. If you don't own SCHD yet, this could be a moment to start paying close attention. Not necessarily to jump in blindly, but to watch how the ETF performs after this move, how dividends trend, and how it holds up during market stress. The biggest mistake investors make is assuming that a familiar ticker will always behave the same way. SCHD just reminded everyone that even the most stable-looking investments can change, and that change is not automatically bad. In fact, some of the best long-term investment stories are built on quiet adjustments made at the right time. This could be one of those moments for SCHD. So here's the bottom line. SCHD just pulled a move that signals adaptation, discipline, and a focus on long-term sustainability. It may not excite traders looking for quick wins, but for serious investors who care about income and stability, this is something to take very seriously. This doesn't mean SCHD is suddenly perfect. No investment is, but it does mean the fund is actively responding to a new market reality instead of pretending nothing has changed. If you've been ignoring SCHD because it felt boring or disappointing, this might be the moment to look again. And if you already hold it, this is your cue to stay informed, stay patient, and understand why this move could matter much more than it seems on the surface. The market is entering a phase where quality, cash flow, and discipline are likely to matter more than hype. SCHD just positioned itself for that environment. Whether that pays off in a big way will take time, but the signal is clear. So get ready, not to panic, not to chase, but to think like a long-term investor. Because moves like this often separate those who react emotionally from those who quietly build wealth over time.